Welcome to the Explainer. If you've walked through a high-end mall recently or maybe just scrolled through some home design feeds online, you've absolutely encountered Lovesac. They're this premium furniture brand, famous for their modular, lifetime guaranteed couches and of course those massive cloud-like beanbags. They've built an incredibly strong omni-channel presence, for sure. But when we look beneath the glossy marketing and actually dive into their latest SEC Form 10Q filing, this is for the first quarter of fiscal 2026, a really fascinating tension emerges. We have a highly visible premium brand colliding head-on with totally flat sales and some seriously complex financial realities. Okay, let's dive into this.
Here is our quick roadmap for today's Explainer. First, we'll look at the Lovesac business model. Then, the Q1 financial realities. Third, where do sales happen? Fourth, we'll get into unique assets and tariffs. And finally, we'll wrap up with legal risks and headwinds. Don't worry, we're going to translate all this dense corporate finance into a really clear story.
Section 1. The Lovesac business model, a one-product powerhouse. Lovesac operates on a design-for-life philosophy, meaning these products are built to last and literally evolve right alongside their customers.
Now, what's really interesting about this slide is the sheer dominance of a single product. You naturally think a company named Lovesac makes most of its money from, well, its namesake giant beanbags, right? Actually, out of their total $138 million in Q1 sales, the Sacs only brought in $7.3 million. The absolute powerhouse of their entire business is the Sactionals, those adaptable, modular couches. Sactionals generated a staggering $125.5 million. So they are heavily, almost entirely, reliant on this one core platform to drive the whole shebang.
Let's move on to Section 2, Q1 Financial Realities, Flat Growth and Widening Losses. Let's look at the harsh numbers.
For Q1 2026, net sales were $138.19 million. Exactly 1 year prior, Q1 2025 net sales were $138.37 million. So, despite having massive brand visibility and expanding their retail footprint, year-over-year revenue remained almost perfectly flat. I mean, literally neck and neck. In a retail environment where investors highly prize growth, staying completely flat is a giant flashing signal that the company is facing some serious friction when it comes to scaling up that top line.
And, as you might expect, that flat revenue translates directly to the bottom line, bringing us to this critical figure. For the first quarter of fiscal 2026, the 13 weeks ended May 3, 2026, Lovesac reported an $11.1 million net loss. It's really important to understand the mechanics here, though. Their actual operating losses actually increased to over $17 million for the quarter. But they had an income tax benefit that softened the final blow, landing them at this $11.1 million net loss. Flat sales combined with rising costs, that equals widening losses.
So you might be wondering, where exactly is all that cash going? Well, the standout figure here is the massive $68.5 million spent on selling, general, and administrative expenses, or SG&A. This covers the overhead, the salaries, just the sheer everyday cost of keeping the lights on and the business running. Add to that another $16.5 million in advertising and marketing, and you can see how incredibly fast that gross profit just gets eaten up. These heavy expenses put massive pressure on their overall profitability, especially when top-line sales aren't growing to absorb them.
Up next, Section 3, Where do sales happen? The omni-channel strategy. Let's talk about how they actually reach their consumers. Lovesac prides itself on being an inventory-lean omni-channel platform, giving you a seamless experience whether you're online or in person. But the reality of their sales? It's heavily physical. While they do have a robust e-commerce presence that brought in $35.6 million, the vast majority of their sales, $97 million, are driven by their physical showrooms. At the time of this filing, they operate 281 showrooms across the U.S. And this brilliantly illustrates that despite being a modern tech-forward brand, good old brick-and-mortar retail remains the absolute beating heart of Lovesac's revenue.
Let's dive deeper into the 10Q with Section 4, Unique Assets and Tariffs, Finding Value in Unusual Places. Beyond couches and showrooms, a company's balance sheet often hides some pretty obscure, behind-the-scenes accounting mechanics. Let's demystify this barter arrangement. Look, furniture companies deal with returns, and that can be a massive drain on profits. So Lovesac set up a clever system where they trade their open-box returned inventory to a third-party vendor in exchange for advertising media credits. Because of this, Lovesac is currently sitting on over $32 million in total unused media credits that they can use to drive brand awareness all the way through 2034.
Let's move to and see how this builds a functional cycle for the company. Step 1. A customer returns an open box Sactional. Step 2.
Instead of taking a huge financial hit liquidating it, Lovesac transfers that item to their barter vendor. Step 3. The vendor gives Lovesac ad credits in return. It's a highly creative transaction lifecycle, really. They're turning what would normally be a pure liability, returned, unsellable inventory, into a future marketing asset.
And here's another really unique financial wildcard we found hidden in the report. In February 2026, the U.S. Supreme Court ruled that certain tariffs imposed under the International Emergency Economic Powers Act were actually unlawful. Because Lovesac imports a ton of materials, they had paid a lot of these tariffs over time. While they've now submitted claims for refunds. In fact, right after this Q1 quarter closed, they'd already collected $3.6 million in refunds. This represents a potential ongoing windfall that can inject some very unexpected cash right back onto their balance sheet.
Finally, we have to look at the challenges. Section 5. Legal risks and headwinds. The fake discount lawsuit.
Pretty much every public company faces litigation, but Lovesac is currently navigating a specific, high-stakes class action lawsuit that's casting a bit of a shadow over their pricing strategies. In March 2024, a putative class action was filed, Noix Dien versus the Lovesac company, alleging they falsely advertised discounts on certain products. The plaintiff is seeking treble damages. For context, treble damages means triple the actual damages, plus punitive damages and injunctions. After mediation failed in January 2025, a motion to dismiss was actually granted in March, but the plaintiff was allowed to amend it, filing a second amended complaint in April 2025.
So what does management make of all this? Well, this direct quote from the 10Q pretty much says it all. At this time, we are unable to reasonably estimate the possible loss or range of loss from this proceeding. So the crucial point is that this ongoing legal battle casts an immense cloud of financial uncertainty over a company that, as we've seen, is already dealing with flat sales and an $11 million quarterly net loss. The ultimate outcome here is completely unknown and potentially severe.
However, to balance out this risk narrative, we also have to look at how management is acting. They are projecting confidence through stock buybacks. They approved a $40 million repurchase program back in June 2024, and then authorized another $40 million right before this quarter in March 2026. In Q1 alone, they repurchased and retired over 141,000 shares. They still have $51.7 million available for future purchases. This vividly illustrates that despite the flat top-line growth and all that legal uncertainty, the company's actively utilizing its capital to buy back shares, aiming to drive long-term shareholder value.
Which brings us to the ultimate question at the heart of this explainer. Can Lovesac navigate this era of flat sales, heavy overhead, and ongoing legal battles to finally rewrite the rules of their own profitability? We know they have an incredible core product that generates massive revenue, and they have these highly creative ways of managing assets like those barter agreements and tariff refunds. But bridging the gap between being a beloved premium brand and functioning as a highly profitable public company, that remains their biggest challenge yet. Thank you so much for joining me for this deep dive into the numbers. Keep learning, keep questioning, and we'll see you next time.